always tell people is that you need to realize that you don't need to invest anything, right? The money that you have is yours and you can decide to invest it. The only reason why you should invest it is if you think the risk-adjusted return on that marginal cash is better than what you can get somewhere else.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 422. Many real estate investors prefer to be passive and avoid the many responsibilities of owning and managing properties. You can do this by becoming a limited partner in a syndication, which affords you the tax benefits and profit participation of owning real estate without the headaches of actually taking care of the investment. But investing in a syndication as a limited partner can be a daunting task. How do you know if you can trust the operator, understand the asset class, or even make a profit when all is said and done? My guest today advises limited partners on existing and future investments. And today he's going to help us understand how to properly LP investments in the grand scheme of our portfolios. Aleksey, and Aleksey, I'm going to let you pronounce your last name for our audience, has underwritten and overseen $10 billion in commercial real estate portfolios in his previous position with Store Capital. Aleksey, thanks for being on the show today.
Hey, thanks for having me, Brian. It's such a pleasure.
Say your last name for us so everyone knows who you are.
Chernobelskiy. But C works.
You represent LP investors. You're an advisor, a consultant, and you wanted to make sure that, as you go on other people's podcasts, that it's clear you're not endorsing that person. In this case, it would be me as a general partner, because I do have syndications. I do raise money from LP investors, but you and I have never met before. This is our first conversation, correct?
Yeah, thanks.
Tell us a little bit about what you do and some of the conversations you've been having recently.
The way that the business started was I wanted to advise LPs on future investments. In other words, someone has a new deal that they're looking at. Typical client is a dentist, software developer, engineer, something like that. And they're looking at a new transaction. They send me a deck and I just give them some feedback based on what I'm seeing. That's how the business started. Recently, it has evolved into a lot more just in the past few months.
This is for people who invest in syndications. They're not people who are raising money through syndication, but actual limited partner investors. And you work with them, they'll send you the deal and you'll kind of help them vet it to see if it's something that's appropriate for them.
Fundamentally, the reason why I started the business is I realized that many people who are very good at making money aren't necessarily good at investing it, right? Those are two very different skill sets, and there's nothing wrong with that. That's just sort of the nature of life. And the goal was to make sure that people are not taking risk without understanding what the risk is, right? Any investment has some sort of risk associated with it. Real estate certainly does. But my main goal is that an LP is investing knowing that there are certain risks involved and the investment isn't risk-free. And you'd be surprised to know how many LPs just don't understand even that. They sort of think of real estate as like super safe and you can't lose money. Of course, most syndications don't lose money, but some do, right? And that's why the due diligence process at the beginning is super important. And in terms of just going back to your question, the business more recently has evolved into still doing future transactions, but a lot of the inbound inquiries I've been receiving are actually on the existing side, mostly around capital calls. So people that have gotten a notice from a GP about a capital call need, and they're sitting in their dentist office or at their cubicle at Uber in San Francisco, whatever, and they just don't know how to respond. Like, do I just trust them, give them the money, or get diluted by not doing so, right? Do I need to ask any questions? Do I have any rights to ask questions? Right? Like it's just sort of many LPs didn't even know what a capital call was when investing, right? And so it's sort of it's an emotional point for many people, and I try to guide them through it.
Explain to us what a capital call is, because up until, say, 2 years ago, anyone who was investing in real estate, because of the low interest rates, there was a lot of success. People were doubling, general partners were doubling investments within 3 to 4 years, getting people out pretty quickly. But then once interest rates started going up, the whole situation changed. So now when you say capital calls, and limited partners getting those capital calls, what does that actually mean?
There's two types of capital calls. What I would describe as the first is expected ones. In other words, like you invested into a fund, right? And there's a required capital call schedule. Maybe you're contributing money every quarter, every 6 months, whatever. I mean, or perhaps at investment, right? Those are not the type of capital calls that I deal with, because those are ones you sort of expected and signed up for when you invested. And that could also be on a deal by deal basis. I mean, let's say you invested into a construction deal, and throughout the phase of the construction, your capital is being called. So again, that's expected and totally normal. I mean, there's no questions there, other than making sure that everything is going according to plan as you contribute capital. The capital calls that I deal with are what I would call unexpected capital calls. In other words, you invested in let's say a multifamily property. Doesn't just apply to multifamily, it certainly applies to industrial, all types of others that I've advised on. And at investment, it was fully assumed by all parties that was the only capital that was required. In other words, the capital stack was a piece of debt, all the LP and GP equity, and that was it. Like that capital, that initial amount of capital was supposed to last until the end, when everyone is taken out and you make a profit. So through many different reasons, sometimes you need more capital. More recently, I would say probably 75% of the reasons are due to interest rate caps expiring, right? Like that has been sort of a trigger of a lot of these. And at that point, the GP has a decision, meaning you need capital in order to survive. You can't just survive based on operating cash flows that you have. And you can either get that capital externally, or you can call capital from existing investors, which is called a capital call.
So you're getting capital call questions from your investors. What kind of communication are they getting from the general partners? Is it like dire, hair on fire, if you don't send in money, we're going to lose the property? Or is it vary depending on the GP and the asset and what the situation is?
I'll be super candid here. I think, and it could be that my sample size is biased, right? Meaning the folks that tend to reach out to me are sort of like not the institutional world typically, right? Because they can sort of figure out how to respond to these things themselves. So it could be that I have a sampled bias, a bias sample, sorry. But from what I'm seeing, the emails tend to follow a really unhealthy pattern. This is not always the case, but I would say probably 70% of the ones that I've seen start something like, hey, everything is going well. Hey, investor, everything is going really well. Second paragraph is, but we need money to finish X, Y, and Z. Third paragraph is, we don't exactly know what the plan is, but we're working on it. And the fourth, we're working on it and we'll send it to you eventually. And then the kicker at the end is you have until Friday to wire the cash, or you'll get diluted if you don't. And so what I see is the limited partners calling me, sometimes freaking out, saying, hey, I obviously have to invest here. Like I only have 2 days left, 3 days left. If I don't, I'm going to get diluted. So it sort of gets their emotions going. But I think, like I said, 70% of the time, the template is very unhealthy, because no one knows the asset better than the GP does, right? And similar to Inception, when it was the GP's job to convince the LP to invest in the project, I think it is also the GP's job at a capital call to convince them why investing in the capital call makes logical sense. Like it is just another investment. There's nothing right or wrong with it. It's just a need. But I rarely see capital calls that are made with sort of enough information to LPs.
that letter template that you just described really seems suboptimal because it goes from, hey, everything's rosy, everything's great, to send in money by Friday or you're going to get diluted, which I can see why that would upset some LP investors. What letters and communications from general partners or GPs have you seen that are actually effective and are optimal by your perspective?
I've actually advised some GPs on capital calls themselves, and I think, to be candid, I think some GPs are newer to this. They've never done a capital call. They don't particularly know how it feels like to be on the other side, right? And so what I always say is you should communicate early. Like, regardless of what you send, by the time you send it, hopefully it's not a surprise that the rate cap expired or that you're running out of cash flow or there's challenges with properties. And many times, unfortunately, Brian, this is not the case. Like, you get very rosy communication up until sort of like the capital call email. And I would say you can almost write anything in that capital call email and you'll have a really hard time, because up until that point, you were communicating positive news, and people tend to lose trust when that's completely contradicted by a big negative surprise, right? So that's the first thing I would say. In terms of the structure of what works is, I think you have to explain to the investor why. In my opinion, I'm a numbers person, and I think investors should be to some degree also. But you have to explain to them in numbers why putting up more money is going to make them more money, right? I mean, that was the pitch at the beginning. You put in 100 grand. I'm going to try to turn it into 200 grand over a 5-year period, or whatever the returns were. So I think the best capital call emails from the GPs will say, here's what we need. Here are the uses, right? The sources of the capital call money, the uses are X, Y, and Z. Here's why we think this is the only capital call we need. I also don't see that addressed many times. You sort of like have a Band-Aid solution on one problem, but you know that you have another problem coming up in 3 months, 6 months, and you sort of like leave that unaddressed, which also, I think from my perspective, makes you lose trust, because you don't want to have two surprises, right? You need to be seen as someone who's like planning long term. And yeah, like I think a plan that is very candid and thorough is important. And one thing that I think it has to include is, how are we doing today? Like, many LPs assume that their positions are in a good place. That can be the case in a capital call situation. For example, you're 90% through construction and maybe you have 10% left, but you're still getting good pre-leasing activity, et cetera, et cetera. Like, and in such a case, you just need a little bit more capital to get through the construction process. But the equity is sitting in a good place, right? Meaning it's not deeply impaired. Whereas many of the rate cap scenarios actually have equity that's impaired. And so my conversations, unfortunately, like, sometimes they turn from, should you invest in a capital call or not? They actually turn to the LPs realizing through me, and it shouldn't be through me, it should be through the GP, that they realize that their existing position is impaired by 50%, 75%. Sometimes the whole thing is gone. And those are just they're painful conversations. There's no other way to put it.
Those sound like very painful conversations. And you have like over $10 billion worth of experience in just underwriting and kind of overseeing assets. Talk a little bit about your background and why you're well suited to having these conversations and helping LPs understand what their position is. So
the 10 billion number that you refer to is, I was an SVP at a public REIT called Store Capital. They recently went private, but at the time I ran a 20-person team, and my job was to make investment decisions on existing assets, which were pretty close to 11 billion actually by the time I left. And that was almost close to 3,000 properties all across the US. And also I ran the underwriting team, right? And the underwriting team's goal across, hundreds of assets that we looked at was, does the risk reward on this transaction make sense? right? What questions do we need to ask? What risk are we taking on? Is that risk well mitigated, right? And so I think that's exactly what I do now. I mean, I almost kind of feel like I'm kind of in the same job, except it's just my own firm.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. When someone does get a call, when a limited partner gets a call from the general partner saying, hey, we need a capital call, we need you to put up more money, what are the steps you take them through to help determine whether they should put up more money?
I have a whole process, but I'll tell you sort of like the highlights. The first thing I always ask is, do you have the money? That sounds like really funny, but many times I've heard people wanting to pull on their retirement accounts to fund it. I'm not here to say whether that's a good idea or a bad idea, but it certainly introduces another variable. And in the case of like a retirement account, for example, if you're borrowing that money, that comes with an interest rate that you sort of have to pay back. So it just complicates the whole situation, right? So now, assuming you actually have the cash, you can take that cash and invest it somewhere else, invest it in another syndication, invest it in the stock market, index fund, whatever, right? And so the second thing I always tell people is that you need to realize that you don't need to invest anything, right? Like the money that you have is yours and you can decide to invest it. The only reason why you should invest it is if you think the risk-adjusted return on that marginal cash is better, right, than what you can get somewhere else, right? And of course, analyzing that comes with some time, right? Like you need to understand what the plan is. Like I said earlier, what is the business plan with the money? How is it going to be used? How do I make sure that there's no other hiccups coming along that might require more money, right? And I think it also starts with a pretty basic question, like where's my position standing today, right? Many times LPs don't know that answer, and hopefully the GP can give an honest answer. And look, I think there's certainly cases where an impaired position can be saved, right, by making a capital call and waiting a few years, and it sort of financially makes sense to actually invest money into that story. But that's not always the case, right? But it's really important to understand where you're sitting today and why this new investment will return you more money than investing it somewhere else.
And what does it mean if you don't put the money in, you don't answer to the capital call, and your original investment is diluted? Explain what that means to our listeners.
There's many mechanisms as to how this works, legally speaking, but essentially what it means is you are penalized for not investing, right? So if you're not penalized, what that essentially means is if let's say there's two investors in a deal, it's just me and you, right? So both of us decide we don't want to participate, but someone else comes in and they dilute us in the LLC pro rata to our investment. So nothing wrong with that. It doesn't really impact us so much because we didn't invest, but he did, right? But the reality is that, the valuation of the raise is different from the beginning to today, right? And so because at a capital call, there's, at least some form of distress happening, right? Typically. And so because of that, the incoming investor comes in and says, hey, like I'm not taking the same level of risk as the people that invested in the beginning. So I need to be compensated differently, right? And the way that people incentivize the original equity to participate is to essentially say that if you don't, you'll get diluted, let's say 2x, or sometimes I've seen 10x. I think that's outrageous for what it's worth, but like I've seen dilutionary measures as a strategy to get LPs to commit money.
Now let's turn our attention away from capital calls and talk about the LP investors who get in touch with you to say, hey, I'm looking at investing in this particular syndication, whether it be multifamily, self-storage, what have you. And I'd like your opinion on it. What's the process you take them through to kind of assess whether it's an investment they should make?
The first thing I always do is just point them to like free resources that I've put out. I think if people are listening and they're in that position, I would point you to lplessons.substack.com, and there one of the articles is top 15 syndication mistakes, and I think you might even be able to Google that and find it. That's essentially a long list of everything that you should look at, and the way that I don't necessarily call them red flags, but I call them reasons to stop and think or to pause, right? And I think you can have that list open next to the deck, and you might be able to figure out on your own, without any help, whether you are not comfortable taking on a level of risk because you continue seeing the deck not meeting certain parameters in that list. Assuming they do want to continue, so they reach out. Typically, we have some sort of conversation. It really depends on a lot, Brian, like how much money they're investing matters. If that is like a really significant percentage of their net worth, then that also matters. But I also, many times this is never like investing advice, but I just, when someone tells me that they want to invest 80% of their net worth into a single deal with one GP, I just say, look, like you should speak to a financial advisor or something like that. But personally, I probably wouldn't do that.
I know you don't like using the term red flags, but what are some of the other things you do look for in deal structure that might give you pause?
There's 15 of them that I like really point out. The reason, I'll just spend a second on this. The reason why I don't like calling them red flags is an investment has to be looked at in its entirety, right? So just to give you an example, let's say we saw that a GP is charging, not charging, but they have like a 50-50 split, right? So meaning after whatever pref, there's a 50-50 split. So it's very easy to just be like 50-50 split. That's not market. That's crazy. Like I'm pass, you know what I mean? But then you start looking further and you realize that they've had decades of experience and they're really good. Then you start looking further and you're like, well, it's interesting. It's actually a 50% split, but that's over a 10% pref, let's say. Then you're like, oh, okay. Then the picture starts making sense. And then you look at the deal itself, the property, that sounds really good. The fees are market, right? Like, so it's very easy to dismiss something based on one fact. And I think wrongfully dismiss it, right? So that's why I'm very careful with using red flags. In terms of what I would call closer to a red flag is not being able to trust the person, right? So as a limited partner, you're silent. You don't have any control over what happens, more or less. And what that means is you really need to trust the person to do their best job during good times and during bad times. This is because I have 3 separate pillars that I sort of advise people to look at. And the first one, in order, is execution. In other words, can the GP execute? Part of that deals with track record. And the other part is just, do they seem trustworthy, right? Like, did you Google them? Were they involved? I mean, just to give you an example, like I recently advised someone who lost money with someone who was sued by the SEC like 15 years ago. and it was completely open in public to see if you Googled it. Now, that's not to say that someone doesn't change their ways, right? But you need to be comfortable with taking on that risk from the start, right? Like, meaning if someone has done this before, doesn't mean they'll do it again, but at least that's public information that's in sort of in the wild for you to see, and you certainly shouldn't ignore it, right? So that, I think that's where it starts. If anything during the, I guess I'll call it pitch process or sales process, rubs you the wrong way, they're saying something, perhaps they're doing something, that's really important, in my opinion, because you're just entrusting this person with your money, and you more or less have zero say as to what happens to it next.
You mentioned 3 pillars. I'm assuming the first pillar is look at the sponsor and do a little research on them. What are the other 2 pillars?
So the first one is execution, which, like I said, is a mix of do you trust them and whether the track record is one that you like and makes sense. The second one is alignment of interests, right? So even if you have a really good sponsor, alignment of interest, at least in my opinion, matters a lot, particularly in bad times. That's where it really matters. And that comes down to a lot of things, but I think the 3 biggest items on that list are fees, the waterfalls, right? Like the split after the pref, and also the co-invest of the GP, right? So that's the second one. And then the third one is the actual property. Sometimes people are surprised, like, why is the property third? But I stand behind that very firmly, because sometimes you don't even need to get the property. You know, you look at the first one, you look at the second one, and you realize that there's enough pink flags flying in the air that, like, even if it's a really good property, you have concerns about this particular GP executing on the plan.
What is your favorite hack or app?
For real estate stuff, I mostly enjoy CoStar. I think in terms of not real estate related, the most recent thing that I found that has been very helpful is the Fit Body app. Like, it creates exercises for you, and it has been super helpful personally.
So CoStar and Fit Body app. That's great. How would people find out more about you or get a hold of you?
So I think you can Google me pretty easily. I have a pretty unique name. I write pretty consistently on 3 places. Short form would be LinkedIn and Twitter. Again, you could just, Google me and you'll find both of those. And long form, I write weekly articles, 2 weekly articles actually, on my blog, which is lplessons.substack.com.
So Aleksey, thanks so much for coming on the show today and talking about how you work with limited partner investors. It's been really interesting hearing some of the situations you've encountered recently with LP investors who are facing capital calls and how you're helping to advise them on those decisions. And then the kind of the process you take them through when they're just assessing new investments that they might be part of. It's been really interesting, fascinating conversation. Thank you so much for having it with us today.
Thank you, Brian. Thank you so much.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.